If you receive Social Security or SSI right now, I need you to stop whatever else you are doing for the next few minutes and stay with me, because there is a rule taking effect for July 2026 that changes who can look inside your bank accounts, how often they can do it, and what happens to your monthly check if they find something you did not report. Now, here's the thing. This isn't some proposal sitting on a desk in Washington, and it's not another rumor making the rounds online. This is a real rule change that's already moving through the Social Security system. Yet most seniors I've talked to either haven't heard about it at all or have only seen scary headlines without understanding what it actually means for their own monthly deposit. I'm not talking about something that might happen years from now. I'm talking about a real change in how benefits can be verified starting this summer, along with a few important details you should know before it ever affects your account. For more than a decade, I've followed Social Security updates, retirement programs, and the financial rules that impact seniors every year. And if there's one thing I've learned, it's that good, honest people often get caught off guard. Not because they broke the rules, but because nobody ever explained the changes in plain English. That's exactly what I'm going to do for you today. But before we talk about the update itself, there's one important question we need to answer first. Why has financial verification become a bigger focus in recent years? And what problem is it actually designed to prevent? Once you understand that piece of the puzzle, everything else about this July 2026 discussion becomes much easier to understand, and you'll immediately see why so many people have been talking about it. But before we dive in, let me ask you something. Are you subscribed to the channel yet? If not, go ahead and hit that subscribe button and turn on the notification bell. Social Security rules change all the time, and staying in the loop could help you avoid surprises down the road. So, what exactly is this July 2026 bank rule that has so many people talking? The first thing to understand is that it isn't about changing the amount of your Social Security benefits overnight, and it isn't a brand new program created out of nowhere. Instead, it involves how financial information is verified for certain benefit recipients, and how that verification is expected to become more consistent. That's an important distinction because many people hear the words bank rule and immediately assume the government is suddenly taking a completely different approach. In reality, this change centers on a verification system that already exists, but is being used more broadly as part of the agency's effort to confirm that benefits are being paid correctly. At the heart of this discussion is something known as the Access to Financial Institutions, or AFI, system. Think of it as an electronic verification tool that allows the Social Security Administration to confirm financial account information when it's required under the rules of certain benefit programs. Its purpose isn't to randomly monitor people's finances. Instead, it's designed to help verify whether the financial information connected to a claim matches what has been reported. As July 2026 approaches, this process is expected to play a larger role in financial verification, which is why so many discussions have suddenly appeared online. One reason this topic has created so much confusion is because people often mix together different Social Security programs as though they all operate under the same rules. They don't. Some programs require financial resource verification because eligibility depends not only on income but also on countable resources. That's exactly where this verification process becomes important. Unfortunately, once short social media clips and dramatic headlines started spreading, many people were left with the impression that every beneficiary would suddenly face the exact same review, even though the reality is much more specific. Understanding that difference is critical, because once you know why financial verification exists, the rest of the rule becomes much easier to understand. It also explains why some people have nothing to worry about, while others should take a closer look at the information connected to their accounts before July arrives. But that raises another important question. If this verification process has existed for years, what exactly is changing in 2026 that has suddenly made it such an important issue? That's where the next part of the story becomes especially interesting. Now that we know this verification system isn't brand new, the next question becomes even more important. What exactly is changing before July 2026? Surprisingly, the answer isn't about introducing an entirely new system. Instead, it's about how financial verification is expected to be used more consistently for certain people whose eligibility depends on their financial resources. That distinction is more important than it might seem, because it's also the reason so much confusion has surrounded this topic. Once you understand that difference, the rest of the picture becomes much clearer. In the past, financial verification wasn't always carried out in exactly the same way for every situation. Some cases required additional review based on the information available at the time, while others didn't require the same level of verification. As procedures continue to evolve, the Social Security Administration is placing greater emphasis on verifying financial information electronically, instead of relying only on what's reported during an application or review. The goal is straightforward: identify potential discrepancies much earlier, before they turn into larger problems years down the road. That may sound like a small procedural change, but it can make a significant difference for people whose eligibility depends on accurate financial information. From the agency's perspective, this approach is intended to address one of the biggest challenges within needs-based benefit programs: improper payments. These can happen for many reasons, including changes in financial circumstances, assets that were never updated, or resources that eventually exceeded program limits without anyone realizing it at the time. The difficult part is that these situations often aren't discovered immediately. Instead, they may come to light months or even years later, after benefits have already been paid and used to cover everyday necessities like housing, groceries, or medical expenses. When that happens, the result can be an overpayment that the agency may later ask the beneficiary to repay, creating stress long after the original mistake occurred. That's why this increased emphasis on financial verification matters. The purpose isn't simply to look at bank accounts for the sake of looking at them. It's to help ensure that eligibility information remains accurate from the beginning, so that small issues don't quietly grow into much larger financial problems later. In other words, the goal is to prevent unnecessary complications before they become difficult and expensive to resolve. This also helps explain why the conversation surrounding July 2026 has attracted so much attention. Many people assumed the biggest concern would be a sudden reduction in monthly benefits, but that's not what this discussion is primarily about. Instead, the focus is on making financial verification more consistent for programs where financial resources directly affect eligibility. Once you understand that distinction, the headlines begin to make much more sense, and it's easier to separate genuine information from online speculation. But here's where many people unknowingly put themselves at risk. The issue isn't always a hidden account or someone intentionally withholding information. In many cases, it's something far more ordinary: an old bank account opened years ago, forgotten over time, and never thought about again. It sounds harmless, yet situations like that can create unexpected questions during financial verification. And that's exactly why forgotten accounts have become one of the most misunderstood parts of this entire discussion. So, why are forgotten bank accounts becoming such an important part of this conversation? Because financial verification isn't limited to the account where a benefit payment is deposited. When the verification process is carried out for a person whose eligibility depends on financial resources, the goal is to develop a more complete picture of the accounts connected to that individual. That's where many people are caught by surprise, not because they intentionally withheld information, but because they simply forgot that an account still existed. Think about how life changes over the years. You may have opened a savings account decades ago to save for a vacation, a holiday, or your grandchildren. Maybe you opened an account at a local bank that later merged with another institution. Or perhaps you joined a credit union through an employer years before retirement. Some people even keep a small certificate of deposit that automatically renews, rarely thinking about it again. None of these situations are unusual, and most people never imagine those old accounts could become relevant years later. The challenge is that a forgotten account doesn't stop existing just because it's no longer being used. If it's still open and contains countable resources under the program's rules, it can become part of the financial picture that's reviewed during verification. That's why relying on memory alone isn't always enough. Many beneficiaries are genuinely convinced they've reported everything, only to discover later that an old account they hadn't thought about in years was still active. This is also why it's important to understand that financial verification isn't based on assumptions. The purpose is to compare reported information with verified information, so the agency can determine whether eligibility requirements continue to be met. If everything matches, the process generally moves forward as expected. But if additional accounts or balances are discovered that weren't previously reported, further review may be needed to determine whether they affect eligibility. The key takeaway isn't to become worried about every account you've ever opened. It's to understand why taking a little time to review your financial records before they're reviewed for you can prevent unnecessary confusion later. In many cases, being proactive is much easier than trying to explain unexpected information after a verification has already begun. But this leads to another important question. What kinds of financial accounts can actually be included in this verification process? And why do some of them matter more than others? That's exactly what we'll look at next. Now that we've talked about forgotten accounts, the next logical question is even more important. What exactly is the verification system designed to find? Many people assume it only looks at the checking account where their monthly Social Security payment is deposited. That's one of the biggest misunderstandings surrounding this entire topic. When financial verification is conducted for a needs-based benefit program, the objective isn't simply to confirm where your payment goes. It's to identify financial resources that may count toward eligibility. And once you understand that difference, the rest of the process becomes much easier to understand. That can include a variety of financial accounts held at banks and credit unions. Checking accounts, savings accounts, money market accounts, certificates of deposit, and certain other deposit accounts may all become part of the verification process if they're considered countable under the program's rules. The surprising part is that it doesn't matter how often you use the account or whether you've completely forgotten about it over the years. What matters is whether the account still exists and whether its value is relevant when determining eligibility. That's exactly why accounts people haven't thought about in years sometimes become part of the conversation. This is one reason financial verification has become more effective over time. Instead of relying entirely on paperwork or memory, electronic verification helps compare reported financial information with information available through participating financial institutions. That doesn't automatically mean there's a problem. In fact, for many people, it simply confirms that everything they've reported is accurate, allowing the review to move forward without unnecessary delays. The goal isn't to create problems, it's to help identify questions early, before they become much harder to resolve. However, if the verification identifies an account that wasn't included in previous information, the agency may need to determine whether it affects the person's eligibility or benefit amount. That doesn't automatically mean someone did something wrong. Sometimes the explanation is as simple as a forgotten savings account with a very small balance. In other situations, additional questions may be needed to determine whether the account should be counted under the applicable program rules. That's why keeping accurate financial records can make the entire process much easier if questions ever arise. This is why organization can make such a difference. Knowing exactly which financial accounts you have, and whether they're still open, can save you from unnecessary confusion later. It also gives you confidence that the information you've reported is complete and accurate, instead of being surprised by an account you haven't thought about in years suddenly becoming part of the discussion. Spending a little time reviewing your own records now is often much easier than trying to reconstruct them later. But here's where another important misunderstanding begins. Simply finding an account doesn't automatically mean someone has done something wrong or will lose their benefits. The real question isn't whether an account exists, it's whether those financial resources affect the program's eligibility requirements. And that's where one concept becomes incredibly important: resource limits. Once you understand how those limits work, you'll see why some accounts have little or no impact at all, while others can make a much bigger difference than most people expect. So, what are resource limits, and why have they become such an important part of this discussion? This is also where many people misunderstand what financial verification is actually designed to do. Some hear about bank verification and immediately assume the government is interested in every dollar they own. That's not the real purpose. Instead, for programs like Supplemental Security Income, SSI, Eligibility isn't determined solely by age or disability. It also depends on whether a person's countable income and financial resources remain within the program's established limits. Once you understand that distinction, the rest of the verification process becomes much easier to understand. That's why financial verification isn't simply about finding bank accounts. The real question is whether the resources connected to those accounts affect eligibility under the program's rules. If a person's countable resources remain within the allowable limit, the verification generally confirms that the reported information is accurate and the review moves forward as expected. It's only when the verified information suggests those resources may exceed the applicable limit that additional review may become necessary. That's the part many people never realize. This is also why accurate reporting is so important. Imagine opening a savings account years ago, setting money aside for a future expense, and then gradually forgetting the account even existed. It wasn't intentional. You simply stopped thinking about it over time. Later, during financial verification, that forgotten account appears alongside the accounts you did report. That doesn't automatically mean anyone assumes fraud or wrongdoing. Instead, the agency has to determine whether the newly identified account changes eligibility under the SSI resource rules. A simple oversight can sometimes raise questions that could have been avoided with accurate, up-to-date records. And this is where many overpayment cases begin. Benefits may continue for months, or sometimes even longer, before a discrepancy is discovered. By that point, the money has often already been used for everyday expenses like housing, groceries, utilities, or medical bills. If it's later determined that countable resources exceeded the program's limit during that period, the agency may classify some of those payments as an overpayment and seek repayment. That's why understanding these rules isn't just about avoiding confusion. It can also help prevent unexpected financial stress later. That's exactly why understanding the resource rules is every bit as important as understanding the verification process itself. One explains what information is being reviewed, while the other explains why that information matters. Together, they help determine whether benefits are being paid according to the program's eligibility requirements. Once those two pieces come together, the entire verification process becomes much easier to understand. But there's one more misunderstanding that causes unnecessary concern for many people. Some believe the verification process depends only on what they choose to report. In reality, that's only one part of the picture. Understanding what else is considered and how it fits into the verification process can make the difference between feeling prepared and being caught completely off guard. That's exactly what we'll look at next. One of the biggest misconceptions surrounding this July 2026 discussion is the belief that the Social Security Administration relies only on the information you write down or remember during an interview. At first, that sounds reasonable, and it's exactly why so many people misunderstand how financial verification actually works. While self-reporting remains an important part of the process, it isn't the only source of information used when financial verification is required. That's precisely why the AFI system has become such an important part of this discussion. Once you understand how these two pieces work together, many of the headlines and rumors suddenly make much more sense. Think about it this way. If you've managed your finances over several decades, it's entirely possible you've opened more than one account along the way. Maybe it was a savings account for a family vacation, a certificate of deposit that quietly renewed year after year, or a credit union account from an employer you left long ago. None of those situations are unusual. In fact, they're incredibly common. The surprising part is that many people simply forget those accounts still exist. These aren't usually attempts to hide money. They're honest oversights that happen because life moves forward and old financial accounts gradually fade from memory. This is where electronic financial verification plays a role that many people don't fully understand. Instead of relying entirely on memory or paperwork, the process compares the financial information you've reported with information available through participating financial institutions. If everything matches, that's generally good news because it confirms the accuracy of the information already provided. If something different appears, however, it doesn't automatically mean you've done anything wrong. It simply means additional questions may be needed to understand why the information doesn't match and whether those differences have any impact on eligibility. That's an important distinction many people never hear. That's also why waiting until you're contacted isn't always the best approach. If you realize your financial situation has changed, or suddenly remember an account you forgot to report, taking care of it sooner is usually much easier than trying to explain the difference after it's discovered during a verification review. A simple update today can often prevent unnecessary questions, delays, and confusion later. That's why staying organized isn't just good record keeping, it can also give you much greater peace of mind. It's also important to remember that verification itself isn't a penalty. It's an administrative process designed to help ensure benefits are paid according to the program's rules. For most people, the process simply confirms that everything is accurate and moves forward without issue. The real concern only begins when reported information and verified information don't match in a way that could affect eligibility or result in benefits being paid incorrectly. That's the difference that matters most. But as awareness of this July 2026 verification discussion has grown, another problem has quietly grown alongside it, and it has nothing to do with eligibility. Instead, it involves people taking advantage of the confusion itself. Unfortunately, scammers have learned that whenever there's uncertainty about Social Security, many seniors become easy targets. Understanding how those scams work may be just as important as understanding the verification process itself. Whenever a government policy receives widespread attention, scammers pay attention too. They know that confusion creates opportunity, and that's exactly what's happening with all the discussion surrounding the July 2026 Social Security bank verification process. As more seniors search for answers online, fraudsters are finding new ways to take advantage of people who simply want to make sure they're doing the right thing. One of the most common tactics begins with an unexpected phone call, text message, or email claiming to be from the Social Security Administration. The caller may say they're contacting you because of the new July 2026 bank rule and that your benefits could be interrupted unless you verify your bank account immediately. Others may claim they need to confirm your account information before a deadline or warn that your payments will be suspended if you don't respond right away. Those messages are designed to create fear and pressure you into acting before you have time to think. In reality, the Social Security Administration does not ask people to protect their benefits by paying a fee, purchasing a service, or providing sensitive financial information to an unexpected caller. If someone contacts you demanding your bank account number, debit card information, online banking credentials, or a verification code because of this July 2026 rule, that's a major warning sign that you're dealing with a scam rather than an official process. It's also important to remember that no private company or individual can pre-approve your financial verification or prevent the Social Security Administration from conducting an official review. If someone promises they can keep your bank accounts from being checked or guarantee that your benefits won't be affected in exchange for money, they're making promises they simply cannot keep. The safest approach is always the same. If you receive a suspicious call or message, don't rush to respond. Instead, end the conversation and contact the Social Security Administration using its official contact information, or respond through official correspondence you've received directly from the agency. Taking a few extra minutes to verify who you're speaking with can protect both your personal information and your finances. Now that we've covered how the verification process works and how to avoid some of the biggest scams surrounding it, there's one final piece that brings everything together: the practical steps you should take before July 2026 to stay prepared and avoid unnecessary problems. So, after everything we've covered, what's the one thing you should actually do before July 2026? The answer isn't to panic, close your bank accounts, or believe every alarming headline you see online. It's much simpler than that. If you're participating in a program where financial resources are part of the eligibility requirements, make sure the financial information connected to your benefits is accurate, complete, and up to date. That single step can help you avoid unnecessary confusion and give you far more confidence if your information is ever reviewed. One of the smartest things you can do is spend a few minutes reviewing every financial account that may still be in your name. That includes checking accounts, savings accounts, certificates of deposit, credit union accounts, and any other deposit accounts you may have opened over the years. Even an account you haven't thought about in a long time is worth checking. If you're unsure whether it's still active, contact the financial institution and find out. A little time spent reviewing your records today is far easier than being surprised by an account you completely forgot about later. Just as importantly, make sure you've accurately reported any financial information the program requires. If your circumstances have changed or you suddenly remember something that was unintentionally left out, don't assume it will simply work itself out. Taking care of questions early is almost always easier than trying to explain a discrepancy after a review has already identified it. Keeping your records organized and your information current doesn't just help the process, it also gives you greater peace of mind. Another lesson from today's discussion is how important it is to separate facts from rumors. As you've seen, there's a big difference between understanding an official verification process and reacting to alarming claims shared online. Before making financial decisions or responding to unexpected emails, phone calls, text messages, or letters, take a moment to verify the information through official sources. A few extra minutes of caution today can save you from unnecessary stress and costly mistakes tomorrow. If there's one idea to remember from this entire discussion, it's this: understanding the process is far more valuable than fearing it. Financial verification isn't designed to catch honest people off guard. It's designed to help ensure that benefits are administered according to the program's rules. The more familiar you are with how the process works, the easier it becomes to keep accurate records, recognize misinformation, avoid scams, and feel prepared instead of uncertain. That's exactly why we wanted to explain this topic in plain English, so you could replace confusion with confidence. If you found this video helpful and want clear, easy-to-understand explanations about Social Security, SSI, banking procedures, and other important financial topics, make sure you're subscribed and turn on notifications so you don't miss future updates. And if you know someone who receives SSI or has been asking questions about this July 2026 bank discussion, consider sharing this video with them. A simple conversation today could give someone the clarity and confidence they need tomorrow.